Okay.
I'm gonna allow for them to unmute. I already know DC gonna probably pop if he's still on here. I'm not. Yeah, he is. But yeah, if anybody has anything y'all want to say, feel free to come on. Mute myself.
I had a quick question. This is Tiffany.
What's going on, Tiffany?
Hey, how long does it take to actually learn this method?
Oh, that's good. That's a really good question. I think it's more like how many hours in a week, or what's your time schedule? Like, really, I would give it at least a few months to really get in and learn, but because it's really one of those things. I tell people, you don't go to a book or go to a video and then be like, I got my notes, and you go to bed on it. One of my favorite things to do is you watch a video or you read a book or both, and go demo trade this thing. Like, go mess up, because I think it's an iterative type thing. Now, granted, for my actual like professional traders, we get them into Elliott Wave in their second year of training. Believe it or not, professional traders, I don't look at you if you can't stay 2 years. Like, you have to have 2 years of training under one of our specific tutelages, going through a path. But they get Elliott Wave typically after year one, or for some people that are a little prodigious, give it to them about 6 months in, because they're already showing that they got the spark. They typically get it within 90 days from that. I mean, like, really get it. But what I learned, it took me about 3 months to really learn it. But the real learning comes from when it starts to spark for you. And that may be at some random point, but I think I would say anywhere from 2 to 3 months, give yourself time with it. But mess up, please mess up. You have to do a lot of charts, but mess up. Don't be afraid to mess up. Don't just run out and be like, oh, I'm going to try to make money with it. No, it's going to hurt your feelings.
Can I answer that as well?
Yeah. Oh, yeah. Kim, you're but see, Kim's a prodigy too. So go for it.
Prodigy is strong, very, very strong. But
prodigious.
I started studying with Mike in September, I believe. And I didn't really trade during that time period. I did a little bit of things that I just saw, but I just really focused on kind of learning this method and a couple other things that we were working on. But it can take long. I'm still learning. I'm still like trying to advance. But a lot of the concepts he talked about today, I was able to kind of grasp within 3 to 6 months. But that zigzag trade or zigzag pattern that he showed, and I'm gonna encourage him to make sure we can drop a link for you guys in Jordan's chat. But so you can have like this paper that you can look at. It's something that you can start practicing today. Like if you're familiar with it look a certain way, but if you're familiar with like a bull flag pattern, that's a very easy pattern to use this zigzag on, and you can like literally use it today. I used it today on Roblox because it was doing a whole bunch of stuff, and it was just it was very clear to see that bull flag. I used it. I saw it where it hit the 61.8, and I got out, and I was 100% because Roblox is really volatile. So if you're familiar with like some basic patterns, like a bull flag or a bear flag, you can use this, this pattern, today, and that can be like your building block into kind of starting to integrate the other parts of the Elliott wave. So I'm saying to say that the whole system can take a while to grasp, but they're very easy, just day one things that you can do, and definitely demo trade or paper trade so you can get used to it. But within a week, you can start using this particular pattern.
Yeah, that's why I say she's prodigious. Like that's spot on. When she mentioned bull flag, bear flag, I was like, why didn't I say that? But because that's exactly what the middle part, this B part of the zigzag is.
Mike, you mind if I chime in on that one as well?
Yeah.
Sure, appreciate it. So just to the question, it's something that is closely linked to that common question of how long does it take to be a profitable trader?
Mm-hmm.
That's a question that's commonly asked. And the same way that I usually answer that question is really similar to what you said, which is it's not a matter of days or weeks or months, but it's a matter of reps.
Yes, sir.
Time is not how much time you have in a thing, but how much of your time is focused on the certain things and focused on the right aspects. And so as you get more reps and you focus on Elliott waves, we can all be on this Zoom and I can pop out next week spitting everything from the Zoom.
Right.
Be like, it's because Jordan is this, and that. No, it's because Jordan was paying attention and then hopped on the recording and watched the recording twice,
Yes.
and then went and back tested Elliott waves this night, and then tomorrow was trying to trade with it and
Yep.
looking at different things live. Right, that's how you immerse yourself in something, and then that's how you end up being fire at it and cold with
Love
it. Besides people who are going, I was on the Zoom, so now I'm mad.
it.
It don't work like that. So
Yep.
you gotta get them reps.
Spot on. Spot on.
Don't be shy, y'all. Unmute yourselves.
J702. I see.
I just want to say, when can he come back on again? And thanks.
I appreciate it. Whenever. I mean, there's tons of topics, so it's whatever.
Jordan Club MSC Friday.
Hey, bro, if Mike is down, Mike, that's when I was telling you about how my classes, I teach for an hour and then we end up, going.
Okay.
So I'm open with it. I'll say this for that specific question. This Friday, I'm still out in Orlando. So I'm not sure if I'm gonna be doing stuff with the family or whatever, but I'm fine. I've done it before where I'll hop off and pass it off to whoever. So if you wanna come on Friday.
Yeah, we can look for Friday and see what's really going on again with the family on Friday, and you might be able to get after. Y'all remind me of the old days. We used to do the same thing after market close. You just be like hype, so you just come on and just do it. Yeah, you go to like 2 o'clock in the morning. That's wild.
Yeah, okay, bet. Yeah, appreciate you. Anthony. Yeah, Mike, you welcome to come back. It seems like everybody loved it, so
I appreciate that. Seriously. It's been a journey. I put it that way.
hand raise. You can unmute J702.
J702, I saw him.
Yeah, you can unmute.
Hey, what's good? You guys hear me?
Yeah, it was good.
What's goody, man? I've been following you guys for a minute now. For like, I stumbled across Jordan's Discord and I couldn't help but catch all the value you guys were putting out. I knew you guys knew. I knew you guys knew what the fuck you guys were on was doing. So, I definitely anytime I could catch up with you guys, I'd lend an ear and shit, and definitely gaming up on the options world, on the options. But I definitely, I'm a small caps guy, I've been trying to perfect that whole thing since it's so goddamn crazy, I'm trying to figure out my little routine, my but my skill set. But I definitely see what you guys are doing with that, with the options, man. And I just been really trying to learn everything I can about that, because SPY alone, if I were to trade SPY alone, just intraday trade puts or calls depending on which way the momentum going to go, and then if I can also figure out like the swing trades, which way it's going to go, like off of levels or divergence or any kind of technical patterns or any kind of CPI data or bullshit going on, like, man, you can really come up on that. Like I hit the three, like when SPY was tanking, when it tanked off highs, I was, for however long that was taking, and I was waiting for that reversal. So I started building a position, and that alone showed me how, like, that got me into options right there. On top of your guys's everything you guys put out, man. You guys putting out so much. Appreciate you guys.
Oh, appreciate it, bro.
So
we on a mission.
I got a quick question.
DC was good.
So again, thanks so much, man. Definitely enjoyed the top-down approach to sort of, one of the things I've been really interested in and have executed in long-term trades, long-term investments, I would say, and longer swing trades over the years. But one of the things you said, like, was really interesting, and I talked to Jordan about this when we first had our original conversation, the intermarket analysis and the ways in which the markets work together and how every market is connected. So you mentioned using futures as a tool in addition to single leg options.
Oh yeah, absolutely.
And so do you ever like combine markets with futures, options, and other instruments and leverage and all of those things within your fund as well? So like as part of like a global macro strategy using
Absolutely.
leverage as well,
So
like risk arbitrage, things of that nature.
So I'm not a stat arb or risk arb person. We're more absolute return, which is in the name. We try to, no matter what the condition of the market is, we try to, make gains for our clients. And so we're not necessarily the firm that you go to say, hey, well, I want to dump off. I mean, some people do, they dump off like a lot of their assets, but we're the ones that we fit into a very well diversified portfolio where you have your core investments like your long-term, your long-term stocks, your VU or your, index type stocks. But what we do is we try to provide alpha or hedging for portfolio. For example, everybody losing their minds this at the beginning of the year. We still been in heaven because the markets that we saw, like, let me just go to the chart. Really going, and I'm going to go to ES. ES is a good one, but I can pick any one of them. Let's remove these. We knew the gig was up about not so, and there's a lot of things we look at, but just showing kind of back into the same mode. The market, one interesting thing about, and I say avoid, I've been all night talking about avoiding the LA wave impulse pattern. But one thing about the impulse pattern that is very interesting is that markets begin and end in impulse patterns. And so when you see something like this at the top of a chart, or you see something like this at the bottom of a chart, and again, we never know the future, but when you start seeing things like this, and there's one on screen, you get a good sense of saying, hey, well, if this is happening here, let's go check somewhere else. And I'll show you, this is, S&P futures, just to, and I'll go through this really quickly. This was the look last year. And I remember plain as day, it was like, I saw the push up and I thought in November, because and I'll show this as well, small caps started and tech stocks started having issues at the end of November. But, the larger caps, it takes a while. But as I started seeing, I'm going from this low, had to little move up, come back to 61.8 is beautiful. I said to myself, I was like, well, let's do our projections. And we did. And I wasn't really, I have some very long-term positions. I'm not looking to move. I'm not one of those people that are going to sell out. Because if you think about the markets in general, your whole reason why you're investing in equities is to build value in something that is going to grow into the future, something that's quality-based. But for trading, your job is to, again, be nimble, see the patterns, and react. So as I started seeing, and I'm typing in levels that now are going to correspond to what is indicative of an impulse wave. So we've got this move here, moved up to 233% of here. This is going to move back to about 50%, 44.7 like we saw in the past. Throw these on. Let's put the 50%, 44.7. See, 50, and it went in succession, 50 first, then come back up, 44.7. I was a little worried that because we made a slightly higher high in the middle of December, and I was like, is that it? But then, right around Christmas, we had the Santa rally, and we made a new high, but that new high was the confirmation for me, because that new high was related to everything before it. Because if I take the length of here, and I moved it to here, and I added on, I think it was 61.8. I'll change the colors here just a bit. Look at that. 61.8 came right through the middle. And I said to myself, I said, we're at the high. We're at all-time highs. We just made a 5-way pattern on the S&P. And I said to myself, I said, wait a minute. let's look at the Nasdaq. And this was a killer. This was a killer. I could have looked at QQQ, but I like to keep apples to apples when I'm doing this type. So this is intermarket analysis. It gets a little fuzzy, but Nasdaq in orange, its higher high was back here when I was seeing wave 3 on the S&P. And let me label these right quick. This was, like you talk about global macro, this was like warning sign from everything. Because it looks just like this. It looks, if I go here, I go 1, 2, 3, wavy 4, 5. You know, the variation was here is like this part of the 4 came down a little bit more, but that's within the rule set. You can do that. It looks exactly like this, 5. But the intermarket was saying that Nasdaq, which is more volatile, has a lot more volatile high beta stock, had peaked in November where wave 3 was here. When you start to get divergence between the big index, like the big indices like the S&P, Nasdaq, and I probably could load on here. I don't want to ugly up the chart too much, but the small caps had a similar thing. Very interestingly enough, if I was to look across the pond, I want to say it was either Nikkei futures. Nikkei futures are probably going to be about the same. And this is Japanese stock market. Yep. Nikkei futures, if I looked at the DAX, looked at some of the other things, they peaked out in September, a whole quarter before Nasdaq, before S&P. The show was over. The unwinding of the bigger money, what people call smart money, bigger money had been unwinding all the time.
Can I interrupt you for 1 second?
Sure.
I love it. I just want you to say that one more time, man.
Yeah.
Those is just so beautiful. I just want to make sure everybody heard it.
Yeah. But yeah, it's like what you're looking for here is how the markets sync. They stay in sync for a while, but it's just like any relationship. When you start to break up, certain parts sort of break off. The S&P and NASDAQ are very, very well correlated, sort of small cap indexes. But what you see is the more risky, the higher beta, as we call it, the higher beta, higher risk, more volatile things, they tend to peak out before the more steady, tried and true like the S&P does. So what I noticed here is I was counting my S&P going into the end of the year. NASDAQ had already peaked in November. But if I went overseas and I looked at the Japanese Nikkei, which is Japanese stock market, they peaked in September, an entire quarter prior to this. If I was to put on the Shanghai composite, it peaked a quarter before then. So there's a succession of things that happen. And once you start to pay at a high level, because I just did it because I'm curious. I'm a very curious person on how things work. That's how I didn't really like engineering per se, at least not what I was doing. But I applied that curiosity and that fact finding, and I want to figure out how this stuff works to here. And that's why I've been here forever. And I said, see you at engineering. But once you start seeing how the game plays at a higher level, it's like you can't look away. See Shanghai. It's SSE. There we go. It's such a weird one to look for. This ought to do it. Yep. You can see Shanghai slightly ahead, right over here, September. There was something else that peaked out in May. I'll have to remember what it was. But you can see Shanghai and Asia. If I put on the DAX, which is German index, let's go DAX index. I wonder whether, let's do DAX future. I probably should switch these over. Hope this doesn't break it. Because sometimes when you mix the data, no, that's fine. It worked. And I know this chart's getting a little funky, but you can see the DAX in Europe peaked out at the same time NASDAQ did. So Asia was the most sensitive here, then Europe, and I could put on the CAC 40, some other stuff, and then the S&P was the final curtain call. But because the U.S. is the largest freestanding economy, because the S&P is the largest sector of the U.S. domestic stock market, when it finally rolled over, everything else had to go with it. So it's like it was waiting for Big Mama to come home, and then everybody had to get the hell out. And so that's really what happened. But you started seeing clues September. the markets were retracing in September, but a lot of people were, again, they were on this buy the dip, buy the dip, buy the dip. They didn't realize that was the last time. What we do as a company, once we start seeing these correlations, and one thing I didn't put on here, I'll back some of these out. Or actually, I'll go to another chart and come back. The bond market. Bond markets, if you've never traded bonds or bonds future, I would say for those that like technical markets, this is a really, really fun market to trade. Really, really fun market. It correlates. Here you can see it correlates with the actual, which is strange. The correlation here is Nasdaq and the Nikkei, but the bonds are slightly inverse to them. But like I told you before, if I was to isolate one of these, and this is what happens a lot of times when you go find LA wave patterns, you're like, I can't find it on one thing, but you can find it on something else. If I go back to, see here, let's go up here. This is one. Bonds were a little weird. Yep, this is the one. I knew it was something odd. Bonds sort of had their like come apart moment in the middle of the summer last year. And instead of, they should have been rolling a little bit higher, but they started dropping off, which was strange. And bonds, everybody in their portfolio loves to say, oh, bonds are supposed to hedge against stocks. That doesn't work in the 21st century anymore, because bonds have a lot of the same risks as stocks do, because really it's the underpinnings of the economic markets that are the issue, not necessarily the bonds themselves. But that's why when we came into this year, the bonds sold off. And I have some larger institutional clients that were just lost. They were like, I don't know what's going on. I'm like, well, you both have equity. Yeah, both, all your capital markets are starting to sell off really hard. All of them. A lot of them didn't hedge, but you could have seen bonds back here. Let me bring up the Nasdaq. Bonds correlated with the Nasdaq, which is kind of weird. But Nasdaq started going higher in September, made a peak, started to retrace. Bonds kept going lower and lower and lower. That was key. There should have been some sort of exchange here, but they did not. You know, Nasdaq made its high here, made a lower high here, and then failed. And then both of them fell in unison until end of May. What you do there is you hedge. You hedge, either you buy real estate, that's one thing. Or for us that play the markets, your puts. You can buy puts on so many different things, and that's been fun. For the rest of the market, of course, as you can see from my my panel over here, I'm a big currency guy too. The currencies, not just the US dollar, but a lot of the currencies came alive this year, where they've been kind of in tight ranges and not giving a lot of play. But the dollar has been just lights out. Even today, the US versus Japanese yen on that CPI data was just beautiful. And it's the same type. Like I said, don't worry so much about, the impulse patterns. Just, this is the same type zigzag that we saw come off here. Let's go up a little bit more. 57, touched it. And it moved lower. This is 200. It was 200 some points this morning, which was it's an incredible move if you look at it on a smaller time frame. It just boom. But very, very confined by Fibonacci relationships. And we trade a lot of these, just like we can trade the yen, dollar versus yen. New Zealand versus yen is going to give you about the same look. It moved back out of it because it doesn't have the same relationship. Euro versus yen is going to give you the same look. We had trades on that as well. But if you notice, these are going to be inverse to what happened in the Nasdaq. See, one went one way, one went the other way. Once you know these relationships, you can play back and forth between them. You can play both of them if you want. But all you're doing is finding wave counts, finding stuff that you recognize, patterns that you see, and taking advantage of them.
Let me ask you with the so you mentioned going short and using puts, but you also use futures. Do you ever, let's say if you identify a wave in a pattern and it's you expect SPY to go down, do you sell ES futures and then let's say, for example, in this case, buy euro yen calls.
Yeah, or I might trade the spot, but absolutely. That's like, I like to do it in different markets. I don't like to, well, I'll tell you what I will not do is I won't short, the SPY using put options and then turn around and short the SPY, as a future, like selling the future as well, because what that does for us is that concentrates the risk all in one same area. But what I'll do is I'll find a relationship like this and say, well, I can still make the same trade or trade on the same idea, but like you saying, executing on like the euro versus the yen or the dollar versus the yen and that SPY call or put, depending on what it is, or T-bond. Because if I add them in there, it's going to be a very similar relationship as well. Yep, treasury bonds went same way as, which is odd. It's just so odd world. But the treasury bonds went the same way as the Nasdaq. But you can play them all, or play the one that looks really good to you. And so this is weird. The reason why I say that's weird is because, let me turn, which one I was going to turn off. Both the bond and the Nasdaq went up initially on the CPI, but as you can see, the normal behavior between the bond and the Nasdaq should be opposite. So after the news event, you can see Nasdaq retraced but kept going higher. Bond should have kept going lower. And so knowing these relationships, even if that first move shocked you, you should know that at the next high, sell bonds, but at the next low, buy the Nasdaq. This is how intermarket works. Because it's just like, again, it's like any other relationship. If you know two things go together, but they're not acting like they go together, eventually they're going to get back together again.
And so preference of instrument. So like if it was me and I was looking at this, let's say just purely futures, it would be buying the Qs and selling the let's say ZN or something at the same time. And doing something like that in the futures market. But what would make you pick an option over a futures depending on what you're doing?
The risk reward profile of the actual future. Like, you never really know with options exactly what you're going to get, but you can kind of model it out to kind of see, well, is this going to be, if it gets to this point, it's like a 5-to-1 or is it 10-to-1 or whatever. With the futures, because the contract is more linear, I can kind of figure out exactly what I'm going to get on the future once it hits one of my Fibonacci levels. If I'm counting the wave count, I'm like, oh, I think it's going to go here, here, and here. Let's see if I can actually back this up on chart. Yeah. Like for this bond, this was a pretty easy one, which means I should have traded this one in the morning as well. I don't know that if I was to look at this holistically, let me back out just for a second. If I was looking at this holistically, and that's a great question, by the way, which one would I trade? Oh, yeah, I would have faded the bond. And the reason why I say I faded the bond, because honestly, this move up is coming back into prior resistance. I see it before I actually draw the fib, because I've drawn this for such a long time. Yep, comes into the 50. Already came to the 50, zigzag down again, and is going to push back up. Same, if you're a price action person, you see the same area, but if you're a fib person like me, just gonna put it on there for confirmation. Let's go 70.07 or 60, 67 touches. Right.
Hey, Mike, just a quick question. Like when you're doing that fib retracement, like how do you know which ones to select on the chart? Like how do you know it's numbers?
Because it goes back to what we were talking about earlier. When you're doing Elliott wave, which Elliott wave I've been doing for such a long time, I know all the rules. Each Elliott wave pattern has this. Like for a zigzag, a flat, triangle, impulse, whatever it is, it has a set of rules. I have those rules in my head, but in the beginning, I used to have them on sheets. And I would flip through the sheets and say, oh, in this situation, if it comes down this much, it's supposed to come up here or here. Like where here it says it gives names to different things. It must retrace less than 61.8% of wave A. Commonly retraces between 27 and 50. These rules, once you start learning them, you know which ones you're looking for. So they're not all the same, but you have to learn the rules. And like I said, there's actually a lot of them. But you can kind of, I slide some of the rules, and once I know kind of what the pattern is. If I see, oh, it's come down here and this A, B, and C, but C is shorter than A, I know this one's going to come back up in here. And you can also kind of cheat a little bit if you know price action. If you know looking at prior points of resistance, you can kind of guess it out too. But it's very specific rules, like a playbook for every situation that you're in. You just have to know the playbook. Like even, for example, here, if you observe that this one comes down to, let's say, 75%, which it did, comes down to 75%, I know based on it moving up and taking a long time to get to 75% and then moving higher. Even if I didn't see this part, I kind of know where this one's going. And it goes up a little bit higher because it took a long time for it to get there. The answer here is 227. And how do I know that? Is because, like I said, I've looked at this playbook for a very long time. And so I can hit these from any spot. But like I said, you're looking at a lot of reps. You're looking at tons of reps. I've probably executed maybe over 200,000 trades, actual trades, from little bitty size to now we do pretty good.
Thank you. I appreciate that. I actually screenshot that little playbook too as well.
Yeah, no doubt. Yep.
Oh, one note on the page that Jordan linked. There's a video how to create Fibonacci retracements. That one is free access, so you guys can check that out if you are looking for that.
Thank you.
But yeah, coming back to your, no problem. But yeah, coming back to your question, yeah, I would, in choosing here, I would, another good way to answer that question too. If you haven't traded some of these markets, but I know a lot of people have traded options. I think options are gracious in a sense because you don't have to necessarily work with the stop loss, assuming that you're not talking about selling. If you're not talking about selling or underwriting options, if you're just talking about long calls and puts, which I recommend because I use them just like that. I don't like the selling side because it flips the risk to a way I'm not really comfortable. But you don't have to worry so much about a stop loss in an option trade. So if you're new or you don't like, or you're new to futures or Forex or even Bitcoin, I think the option is a better play because it gives you a lot of the upside. It's a little bit more complicated. It's not as linear. So even though the price can go up, you still can lose some or you still don't make as much. But I think when you get the direction right and you're using something like an Elliott wave, you can really maximize in using the option. And so I like the futures for kind of a loaded reason. At our size, and again, our fund just crossed 10 mil. Once you start to get big numbers, I know some traders that still can trade at size at that size, but once you start to get in size, you really need a market that can give you the depth that you need to get all your contracts in and out safely, because there's nothing worse than making a trade, it goes your way and then you try to sell it and it's like there's nobody home or there's not enough to fill you out. If you have to work for an agency trader or a market maker to get you out, you're in trouble.
So it's part of the decision and executing strategy too is liquidity, sounds like.
Oh, absolutely. Liquidity to me is everything.
Yeah. Well.
Yep. I mean, when you're, like I said, when you start, it's your count. My account started with 3 digits, we use 3-4 digits. Liquidity doesn't matter that much, but I always say you ultimately play like you practice. So I always started out with the intent that I would one day run a fund. When I figured out what that was, I wanted to play very seriously. I always watched the liquidity of what I traded and made sure, if I'm looking at the depth of market, looking at level 2, level 3 data, that I could get in and out at the size where I saw myself in the future. Which led me to go, like, even though there's some options I love to play, it's like, yeah, I can't play some of the OTM because I play a lot of out of the money options. I love those. because they give you the best bang for the buck. And if you have something that can help you look for the outsized moves, you can statistically take the anomalous thing that's not supposed to happen and make it into a much bigger trade. But you can't do that on, oh, I got to deploy $2.5 million to do that. So, because if I'm right, I can make 100 billion. No, you can do that with $200. You can do that with 2,000. You can even do it with 20,000 in some markets, but you have to be very careful because otherwise you're just going to get eat up by nobody being home. So yeah, liquidity definitely matters, especially if. Was that?
I was saying it sounds like excuse me, when you get to that level too, like obviously order flow, order execution, different exchanges and dark pools and stuff, you know, people being able to see what you're doing as opposed to on the resale side, you know, nobody cares, you're small, but like for you, what you're doing now, your contract size is significant. So like if you threw out 100 lot of ES, people would see it.
Right. Well, you know, so the funny thing about that is, and that's when you learn how, like you feel like I felt big growing from, again, 200,000, 2 million to, 10, but we're still very tiny in the big pools now. So we still can kind of fly on the radar, but I know what you're saying. And to be honest, the one brutal thing that I love about futures is the fact that everybody can see. What they can't see is your stop loss orders if you place them correctly. Now that becomes a whole, we could talk for hours on stop loss placement, you know.
Yeah, they got the limits on the ladder though.
Yeah, they got limits on the ladder, absolutely. So but yeah, it's I've seen stops and stuff run, and the other thing that I love seeing is when you plot out your waves right, I've gotten to where it looks like I'm like, man, I'm gonna get stopped, and it turns around a few ticks off of where I was, and I went, wow. And that really, like, having those types of experiences solidifies, like, I know there's lots of stuff out there, like to say there's AI, ML, most of the markets now are being pushed by some type of non-sentient arbiter. So, people worry about that kind of stuff. I don't worry so much about it. I worry more about, can I execute the plan exactly as I planned it and let probabilities take space? And so far, I don't have to worry about market manipulation and people walking, because I think what we do is still so very odd that it either works in tandem with what they're doing, or it's just we're kind of off in our left field. But we'll figure it out. When all of our orders start getting eaten up, I'll know it's time to change. But until then, this is it for me.
And do you ever, and I've never had so this is amazing from an Elliott Wave perspective. I mean, I've never had a deep dive like this. And so as you were going through your journey and mastering this strategy and technique, do you ever lean back on patterns and trends, channels, things of that nature? Or do you exclusively use waves now?
I think for the basis of what I do, like I said, the basis is really wave based, because if I'm struggling, we have some patterns. I can show these. We have some patterns that we call our 8+ trade setups. We actually got it from another group. But if you look at them over time, like you can see channels and things of that nature that form up the major. But if you look really closely, there is some type of Elliott wave pattern that's going on there. And we know based on, and really, again, it's ABC with another little Elliott wave impulse. We knew it was going to pull back here to 38.2, because if you look across all price action all day, pulls right back to here, it's going to go up to here. And that's literally how it played out. And we do some intermarket. These are really, really old charts. Really, really old charts. But you can see how it played out on a much smaller level and went exactly where we thought it would. So there was a pullback, then it moved into 61.8. We have a lot of these that if we're struggling or you're not hitting your goals, there are these types of plays that we look for. And once you know the patterns, there's no reason to go back to using something else. It's play your patterns that you know. And we always have, like, like I said, like the zigzag, it's a really simple one. It's one that we say, hey, this is simple. You know, and again, the guy that did these charts now works at a $35 billion hedge fund. I couldn't keep him, wouldn't keep him from that. But yeah, I wouldn't keep him from that. He's brother, so want him to kill it. But we just trade the patterns that we know. We literally, like, again, this is a zigzag. It's just we're measured a slightly different than we normally do. This is a machine generated picture. This is one of our trading signals seeing the same thing that he did. And that's how we know our patterns work. So I think we have a lot of confidence in the fact that we've over time trained people and machines to see the same stuff and respond and get a positive expected return over time. So yeah, I don't really go backwards like that. And that's not to say that, you know, if you're struggling, go back to where you're comfortable, you know, but I think our comfortable spot is here, you know, in the waves. So
And can you go back to that journal one more time?
yeah, absolutely.
Okay. Yeah, I learned today. So you know, this is I learned. I was today years old when I learned that you could add sub tabs within OneNote.
Oh,
I'm like taking notes on OneNote right now, and I learned just now that I could do that. I'm looking here and it's like make a sub page. I'm like, okay.
Yeah,
here we go.
we're deep. Yeah, we're deep in. I mean, this is we've been doing these trading journals since 2013. This is like the very first one. But yeah, we've been deep in this for years now. But it's been and I tell people all the time, journaling is part of what makes a trader a trader. You know, if you're not journaling, you're not documenting, and we do it for everybody in our group so we can see from people who, again, casually or didn't make the cut, to those that, like I said, even the hedge fund boys peep back in here every now and then. But yeah, you keep it open and you get better over time. But yeah, sub tabs for sure. Like we get deep. I think you can go 3 or 4 levels deep. So
wow.
Yep.
Much appreciated, man.
No problem. Any other wild thoughts?
Someone in the chat asked, what is your way you see when volume is picking or dropping off? Picking up or dropping off.
Yeah, so that is so very dependent, because one thing, and I didn't discuss this a lot because this gets into the actuals of wave theory, is that let's see if I put some volume on here. It depends on where you are in the market. Typically, if you see a big, I would say volume quantifies what you're already thinking in some situation. Let's see if I can do volume. This ought to be a decent market to kind of show, even though it's cyclical. So pick up and down in volume is also a very cyclical thing. Now, if you're talking about stock, I don't pay a lot of attention to stock market volume in the 21st century, because there are so many different types of players out there that it's really hard to gauge. But one of the things I like to do, let me see if I can show this. I use volume with candlestick patterns in really odd ways. And I know this is off Elliott wave a little bit, but this is just more of like what I teach at Blacks and what I actually do. But if you pay attention, there's a candlestick pattern there's actually a really unique one. There's a 4-bar pattern that's really unique that we've documented a lot. It's a very high probability turn signal. But let's just focus here on this one, which is basically a bullish engulfing. Got a big red candle down at the bottom, made a double bottom over here, and then you got a green one with a tail. You know, it's like an inverted hammer. It's like a shooting star, but except for it's in the wrong position. Notice the volume here. On the red one, you had really low volume here. There's only 24.5K contracts on futures, and that's really low day on futures. On this, that's at support. What that's telling you, and really everything leading into this to me kind of tells me that the volume here being low, and then the bodies of this candle shrinking after falling here, is that they've run out of juice. what makes this candle, other than the fact that it's a 2-bar candlestick reversal pattern, the huge kick up of volume here, but the price itself, the open and close, it didn't really go far. You had a big spike here, but that's because you had a lot of people selling in. You had 72,000 contracts here versus 24. So you had a lot more commitment here. And this is where you want to get in, but unfortunately, most people are only going to get in the big one right here. So they're going to miss the actual signal here, but the signal here is what we call an inversion. You have a little bitty candle body that's green that's saying, hey, we reversed. This is a candlestick. If you look at any of the classic Japanese candlesticks, this is a reversal pattern. But what you had here was an inversion of the volume, where the volume on the selling side was really low, still net negative. And then in the next candle, it switches to very positive, almost 3 times as much. But the body didn't go anywhere. That's where you want to be. That's where you want to get in. It doesn't look like it, but that's really where you want to get in. All things else considered, I mean, if I was to count the rest of this thing and do wave counts, you'll see that there is something at this level anyway, but that happens a lot in different types of markets. You have to look for those little inversions. There may be some at the top, they look a little different. They tend to exhaust themselves at the top. Whereas, like, for example, if I was to look at, and I'm just looking at the peaks here, it's hilarious. These giant volume, this is 113,000 contracts. Up here at the high is somebody getting it wrong. They're buying in way late. You want that. That's good. Versus over here, you had, again, big candle on low selling volume, bigger candle, engulfing candle on big volume. That's pretty normal. But the signal here was the low candle, even though this candle body covered a lot of range, the actual selling was net negative, but it was not that negative. So notice how I'm basically comparing an inconsistency. Normal market operation, you're going to have big candle, big volume. But if you have a big candle of either color and you have low volume, really check to see, because this probably means that the market's changing course. And you don't have a lot of time to really confirm it, though. I'm on 2 hours, but if I was to scale down, it gets shorter and shorter and shorter, but it still works because I still use it on the 3, the 5, and 10-minute charts as well. And even from here, though, I can see. It's funny enough. Same. Let's put this on. Yep. There's a little zigzag right into there. So again, I see these patterns. You combine them with that sort of thing, and there's nothing wrong with getting long here. But if you're really on it, you probably could jump it here, which would seem very counterintuitive, but you could. See up at the top, yeah, you're gonna see a lot of exhaustion here at the top. Let me move these out of the way. But look at the peaks. If you look at the peak here, its highest volume corresponds to this candle. And I like futures because they're not like Forex and Bitcoin. You can kind of hide. Any decentralized market, you can kind of hide, but futures market, everybody sees you, so you have to play the part. But look at the next successive high. Look at the volume. There's one that's kind of off in the weeds, but the highest high has nobody there. Notice that volume's way down in the weeds. That's volume-based divergence. Trend in the price is going high, the volume is dropping off precipitously. So this is a really cool, like, classic John Murphy TA type, volume-based divergence. So it's there, And then again, I love my candlestick patterns, and especially this one, where you get big bar. It's like a morning star, but it's actually 4 bars. This is a very high probability. You don't see it a lot, but that's a high probability setup. I would jump at this 9 times out of 10, and you're going to hit 9 times out of 10 on it.
Someone asked if you recommended any books.
Oh, funny enough, with trading books, I only have two for Elliott Wave. Robert Miner's, this is the first, it's like the first book that really taught me trading with Elliott Wave, like actual trading. And I would avoid every other book other than these two. Robert Miner's Dynamic Trading. And my favorite, but I love to hate this book. It's the best book on Elliott Wave patterns, like really breaking the patterns down, but it is a dog to read. I hate reading the book, but that's why I memorized it. I hate reading it so much. This guy named Glenn Neely, he wrote this book in 1990 called Mastering Elliott Wave. It's the most gibberishly written book on the subject, but if you understand it, you're seeing somebody who's practiced what that book has put out. And I've kind of put my own spin on it. So I guess if you wait a few more years or whatever, I'll put my own book out, and I'll recommend that one. But till then, I think those two are the best on Elliott Wave. In terms of trading, not gonna lie, I avoid the Alexander Elder, trading for a living. I avoid even the Mark Douglas's book is not bad, but I've read so many books. Most of my books that I like in trading are super technical, or they're not about trading at all. For example, probably my favorite book on trading that is not trading related is Anti-Fragile. And I caveat that, say Fooled by Randomness. They're both by the same author, Nassim Nicholas Taleb. Both of those books were pivotal for me understanding risk. See, the Bernstein book on risk is pretty good too. But no, I think those three, if you had to read any books that expand your mind, I think you have to be in a certain spot, but I tend to shy away from books that are like, make you feel good. The one make you feel good about trading book, I would say, is One Good Trade by Mike Bellafiore. It's anecdotal, but it's by one of the guys who started one of probably the best prop trading firm in the world right now. They've been that way for probably 12 years. Like they're getting better and better, which is insane. The amount of money they made in 2020 just was that they had 23-year-olds knocking down 8 figures. Now, granted, they had been with the firm since they were 2021, but still, they had some real killers. And that book kind of describes their process. The process is, again, like Jordan was saying, you get your reps in, you talk to your group, what y'all are doing really, making sure your every trading experience is a multiple experience, and that compounds your experience. So it compounds your learning. So those are my 4. If I think of some others, I think I've read over 200 books in trading alone, not counting investment books. Most of them are trash though. No, this is me. I think most trading books are crap.
Man, what's funny is, and this is the first time somebody has said that, people have been getting on me lately because I haven't said they're trash.
Yeah.
But not verbatim. But people been asking the past 2 years, what books? And it's low key kind of like people hitting the what indicator.
Right.
I'm like, bro, the point isn't to just throw yourself into all these things.
Mm-hmm.
Because even if you one, like I said last time I talked about this, is a problem that a lot of people have is getting so lost in the books.
Right.
Read every book under the sun, but now you have very minute knowledge about everything.
Yeah, you surface.
You can't do nothing with it.
Nope.
Or how to use all the indicators, or you got all these indicators on your screen, but you don't know how to truly grasp them. Like you said, you see a lot of people using fibs wrong.
Right.
And we've had people on Zooms before who were talking about fibs, and then somebody's like, well, show us how you set your fibs up. Wrong. Right. So it's just interesting to hear, for once somebody say the same.
Yeah, I'm just gonna be honest, man. I used to, and again, it's that curious kid in me that was just like, I love to absorb things and try to I'm a builder by nature. That's why I went into engineering. I love to build. And so I was like, I'm going to build a trading system or a trading thing. Man, you try a lot of stuff in the books and it's like, what? And it's not, I'm not talking about like try one time and fail. Again, we've set up computer systems that have back tested literally billions of data points, trying some of the stuff verbatim from the book. It does not work. And we went, okay, but I'll only hint at this, there's a reason why I stuck at the pattern stuff at Elliott Wave. But it's because what our systems told us about it has some validity. Now, that's not to say that all the systems and stuff doesn't work, but that's just the world I came from, is like where you rigorously test random sets of data. You let a machine do it because it's not going to make the same errors that a human's going to make, but you take the human and interpret the data, and then you make your decisions based on that. Well, we had that machine cranking, man. I crank through books, find something. Oh, this is interesting. Nah, it's trash. We went through stuff. And what came out was just interesting. There's fascinating stuff out there, but a lot of it just makes you feel good. I don't want to make feel good. I think making money feels good. Having my time back feels good, but reading those books and stuff. But the books I recommend to you aren't very fun, but if they're not talking about risk management, they're talking about how to maximize trades and how to maximize, again, time and how to operate in a world where you don't have all the information and you don't know the outcome. How do you win in that? And I think a lot of the books that I gravitate towards, even now, especially, that's all I want to know. How do I do that better? So you can pick up in almost any trading skill, but I think there's a wisdom in actually doing, which is why I'm like, I tell demo, then trade, get your feet wet, demo, but always, even now I have demo accounts, 8-figure accounts, but we got demo accounts too, because I want to make some mistakes without ruining my reputation or having some client go, I thought you were good. Yeah, I've had that happen too. The one thing I will tell you, the world of hedge funds and trading other people's money is absolutely fascinating. It is also one of the worst experiences you could ever have as a trader. I think if I wasn't doing it for a much bigger reason, I would much rather be a prop trader sitting at home in my underwear like I was in the beginning. That's a much better peace of mind.
Yeah, I heard.
What made you switch from so you said you were a CTA, and so
yeah, still CTA, but
so
upgrade.
I used to work with a guy that he was a bunch. So everybody was CTA. So this was back in like 03, 04, right? But like that's why like when you started off talking, I was like, sitting here two old men, but not like
I love it. That's amazing. That is amazing.
but like, how did you decide like I'm gonna switch from the CTA world, prop world, and all of that to managing other people's money on a large scale, institutional level? What was kind of that thought process for you?
Well, to be honest, I would have loved to have just stayed. And again, we still registered as a CTA as well, but
yeah,
I read about like the thing that I saw, and this is always a personal thing, is like when I found out about this world, I was like, what in the hell is this? Like, you mean there are people who make hundreds of millions of dollars and they don't shoot a ball or they don't sing and dance and they're not on movie screens? What do these people do and look like? And I found out none of them look like me. There was one guy from Canada that one time, like Michael Chang from Canada ran a hedge fund for a long time. And I realized, I was like, wait a minute. These are people that nobody knows. Nobody knew who John Caxton was. Nobody knew who, you hear about Soros or you hear about Buffett, but you don't hear about Buffett in terms of running a fund. You don't hear about Victor Niederhofer. You don't hear about the GOAT, Jim Simons, who's run Renaissance since 1982. Dude's like 90 years old, made $24 billion cash money and set up his company such that even the IRS couldn't touch him. They're trying to touch him now, but it's like he made it such that He had a company of nothing but geeks to do algorithms and learn trading, learn it. But instead of just paying rich people to be rich, all of them became rich. They became their own fund. He turned their fund into their 401k. And in doing so, he skirted some of the taxes. And most of them, even the secretaries there that worked there, were like millionaires. And finding about this world, I was like, well, how do I do that? Like, this trading stuff is cool, but how do I get to that next level? And that kind of just started the journey. And I realized, I was like, as a CTA, you can, self-register. But once you get in that system, you can go from a CTA to a commodity pool to a registered investment advisor, or backwards, or you can do special investment products. You can go private equity. You can do a lot of different things once you get your feet in the door and survive. The problem was surviving and getting the right people to give you money, which is, that's a whole monster of a tale. Like, I nearly crashed and burned trying to solicit clients, because again, it was like, yeah, I even had people say, you sound like a white guy on the phone. I was like, really? But when they see you in person, or you're trying to sign the dotted line, they're like, eh. So there's a lot of that still in that industry. I mean, the industry is mostly, and I would say 97% white, next to nothing black, a few other minorities, but it's a very insulated world, because where else can you make this type of money? And a lot of them can even make mistakes and still recover. John Paulson, guy made a lot of money in 08, billions, started up a gold fund, crashed and burned 3 or 4 times, burned a lot of people billions of dollars. He's still in the game. So learning about that world was like, I was like, I want that, or at least I want enough piece of it to where we can kind of replicate and have enough of us to kind of survive and do our own.
Makes sense. What about that CTA to RA conversation? Like, when you think about RA and sort of what those hoops are.
Yeah. I mean, that was
in terms of licensing and all of that stuff.
What's
capital requirements and all that.
What's hilarious? CTA has a much higher requirement in terms of pain threshold from regulators than RA. Stuff we do for an RA is yawn work. But the audit, actually be audited as a CTA, was one of the most stressful things I've encountered, professionally, because the level of scrutiny is much higher, and you still get that effect of you don't belong here. But yeah, RA made sense, because once I started, outside of learning how to trade, I realized, I was like, I don't know, something that clicked along the way was, I realized that once I left, DOD doing engineering, I had this pool of money that, I've been putting away all stuff in my 401k, but then I was like, I can manage that. But I looked at the assets and said, hey, I'm working as a trader, but these assets are growing on their own. Something hit. And I had a couple other buddies that were like, Doug, we've been trying to tell you this the whole time. So looking into the bigger world, I was going, portfolio asset management is the bigger thing, because it's one thing to work as a trader to make money, but that's active engagement. What if you were able to 2 and 20 your way? And I'm talking about fee structure, 2% management fee plus 20% performance, which is typical of a hedge fund. If you're able to do that, making passive money, plus you've got your own passive stash over here, plus you've got a couple other things going on, the passive money, the older you get, becomes way more important than, even your love of trading, because it's like, this is what people are talking about. You're making money, or your assets are growing while you're asleep or doing whatever you want to do. So it was a natural progression to me to kind of look at that as well. So
awesome. Somebody said you forget the book, you need a movie. I agree.
No, man, I'm just a guy. I'm just some guy, man. I'm literally just some guy. And I haven't crashed and burned enough to fail. We've had a lot of mistakes, but yeah, my goal is just to see how big we can get without ruffling too many feathers. But I want to have some other, we need more of us in the game. I mean, you look at the disparity in just lending. I was looking at, I can't think of the guy's name, but he's a black real estate, like multimillionaire. I think Don, but he was basically talking about the amount of money that was given to white startups and businesses versus non-white startups and businesses. Of $68 billion, 99% of it went to white startups. And so it's like all the other minorities were fighting over the other thing. And I was like, well, what happens if that becomes just 1% or 2%? That changes the game for us. So yeah, I mean, I think holistically thinking about it, like if I can be the model that somebody else goes, I can do that better, and therefore the culture for the community, then, you know, I'm like, well, we'll start to see radical changes. We'll start seeing more things our way getting funded, and we'll start having more political seats at the table and all the other stuff that comes, trappings that comes with actually having real wealth, not just talking about it, or having one billionaire, you know, one or two billionaires that happen to be Black, but their lives are completely different, you know, than the rest of us. So it's better to have 1,000 Black millionaires than it is to have one billionaire if you're looking at it from a risk standpoint. That
Absolutely.
one billionaire is a single point of failure.
Absolutely. So like with your engineering background and the integration of Elliott waves into your intermarket dynamic trading, how do you think that influenced your use of an affinity to Elliott waves as opposed to some other types of techniques? Because you know, one of the things I noticed is when I asked the question about timing, and you have it on the charts now too.
Yeah,
it makes sense to me, and you could really quantify stuff and coordinate different strategies across different markets. So do you feel like having that background gave you an edge for somebody that doesn't have the background though?
It does.
In engineering? It
does, but it shouldn't limit you. One of my richest, wealthiest friends is actually who went into private equity, but he went via like trade. He traded for a while and then transitioned to real estate and transitioned to private equity. He's an English major. It's how his mind works, you know. And I would say the same thing is, if you're of the proclivity to kind of want to solve problems, I went to engineering because I'm that type person. But like I told you, when I got to engineering, I was like, this kind of sucks. And it wasn't engineering like at a broad scope. I loved the fact that I got an engineering degree and I was challenged to learn how to think. And I think being able to think in terms of math and stuff, yeah, I think that gives an edge, because I mean, what are markets if they're not numbers, right? So numbers, or at least that's at least one expression of them. But I don't think it will stop you if you're just a person that's curious. Like I say, if you start with the curiosity and you can kind of follow a process, because I think that's the main thing. The problem I had to shed as an engineer was thinking that I knew every damn thing. Like the market really cured me of thinking I got a wife too, so she kind of helped out with that as well.
Yeah.
So yeah, and then I got kids, and I'm like, I don't know anything anymore. But the markets stopped me from saying I know to I think. I never really got to the whole I believe, because that doesn't work very well for me in the markets. I'm not that lucky. But like I said, it's more the engineering forces you to like think that you know. I had to give that up instead of being like, well, let's take a look at this and see how close we can get to being on the side of probability. And that was a complete mind shift. And that was another reason why I had to leave too, because I was around too many egos and stuff that were like, I know, and they had to be right. I don't have to be right, you know. I just have to execute my plan.
That's what Jordan talks about all the time.
Yeah, I mean, you ain't gonna be right. You're gonna either be right or you're gonna make money. Which one? You're gonna pick one. You know, you're gonna be right. And I have a lot of people, look at my trade. I don't care. You know, I've had the goofiest trade stuff that I just didn't think was gonna work, and they work out fine. I have other things I planned for months and it blows up in a second. I go, back to the drawing board. So yeah, there's still a lot of randomness, but there is some order out there as well. But yeah, you just don't know. You can get close.
The market don't give bonuses for win rates.
Man, exactly. Yeah, I tell people all the time, you know, it's strange enough, the people ask me, like, what's your win rate? I say, man, if I hit 50%, I'm killing it. But that's because of our style. Our wins are like this, and our losses are so tiny. But there are other people that they flip that. But for me, I'd much rather have like, that was the other. So another question about the whole like CTA to RIA to bigger size. I can't tell y'all what type of liberation comes from the mind when you make one trade a year and that trade pays for everything. That's a new experience for me, but that's like when you hit that one trade and it's like, oh, well, I'm done for the year. You don't think, oh, well, I'm going to make X, Y, and Z. No, you're like, I'm free. And I used to do that when I first started in Forex. I used to get up enough to where I would pay up like my cable bill for cable and internet for like the entire year. But it was what I was doing was freeing up my mind. That was almost completely opposite of when I first left in 2015. I was going to trade for a living. All I was thinking about, oh man, I make the performance, I'm going to pay the bills. That nearly killed me. Because the pressure you put on yourself to emulate a salary from trading, which is not designed to do that. It's dumb. And I tell all of my traders, like, do not come in here thinking I'm going to make this much a week. You're going to get what the market gives you. You're going to get what you prepared for, maybe. But now I'm like, sort of like the name of that book, that One Good Trade book. I'm just looking for that one good trade because now it's gotten to the point to where if I hit it, everything else is just whatever. And then my next hat trick is to be like where it does not matter. Hit a trade, don't hit a trade,
Man, that's so that's one of the things that I talk about when I'm giving some perspective on my trading and like how I view trading.
Yep.
This is trading and I'm running a Discord where there's a certain amount, like I can't just call out 2 trades a month and be like,
right.
And my win rate when I'm calling in a group, I consistently have a 75, 80, 85, 70s, right? An 80 to 85% win rate, like week to week. And I'll still be like, yo, at the end of the day, I'd rather take 5 trades, lose 3 of them, and they be 10%, 5%.
Yep.
But then I get 30%, 40%, 80%, whatever. Cool.
Right.
Who cares? I can go 1 and 5.
That's what you want.
But if my one win is at 80% and all my losses are 5 or 10, I don't care.
I found out just by association that bigger funds were literally doing that. They were taking, like I knew of people who were doing like agency trading, high frequency stuff. They're taking like, millions of trades a month. But when I saw the type of funds that were doing what I wanted to do and they were doing at a high level, I'm like, man, how many trades y'all taking? They were like 4. When? They were like all year. And I'm going, what? And then it hit. I was like, this makes, they build this position and they unwind this position because it was a difference. Like, again, it's like when I first started trading Forex, my orders if you trade Forex, even futures, your orders go in within microseconds. The bigger we got, the slower the orders got in. And I was like, we're still tiny. I was like, what happens when we're at, like I said, 100 million or we're at 500 million or a billion? It would take days sometimes, or, like I said, or unless you have to be very sophisticated. I don't know if I'm ready for that world to unload orders in and play these strategies, or you have to play something else, or you have to do like a lot of them do is cheat, but again, being shaded as I am not of the proclivity to cheat because I probably would not survive. They catch me cheating, I'm going somewhere where I don't want to go. So.
No, please don't get caught cheating.
Man, this is.
Have you heard of what's his name? So Ken Griffin. I know you heard of him, right?
Of course. He was one of the Titans.
Yeah. So, I almost got a job there. This is when I was in Chicago.
At Citadel?
Huh?
At Citadel?
Yeah. Yep. Almost. But I was mad at them for a minute because when it was kind of like the ego kind of thing that you talked about.
Yeah.
And that's what at least personally, the group has been really good with that in terms of the psychological aspect of trading.
Yeah.
And so you talked about being right and separating yourself from engineering and engineers that you kind of know or feel like they know.
Yeah,
But
you get caught up in that.
what was a turning point for you? So psychologically, when you said, okay, well, I'm gonna not only separate myself, but I'm gonna go in and just take what the market is giving me, take my set of tools, and then use these tools to extract with as few amount of trades as possible what the market is giving me. Like, what was that turning point?
Ooh, pain is what. So I would take it back to probably 2015 when I first got out. And again, it was like the rush of being out on my own. I had my own money, again, my family's going nuts, by the way. They thought I was absolutely insane. And I'm like, again, riding ego. I'm like, y'all have been eating off of this or seeing y'all been taking trips off of this. I'm in my, hey, look at what I've done for you. But not adjusting to the distractions of running a business, thinking that, oh, I'm so good at trading that I'm also good at running a business, right? That I take my domain expertise and take it to a completely different area and think I'm going to be, I guess like Ben Carson, you know what I mean? I think it's going to be like the Ben Carson moment. I'm the #1 neurosurgeon in the world, but now I'm going to run HUD. I took that, I was like that in running my business, but I did so poorly that when it came time to eat, and the way our fund was set up, we only got paid on a monthly basis. And I actually took it down from quarterly. First, we were just quarters, then it was like monthly. I kept missing. And I going, wait a minute. I thought I had this. And it's like a month would go by and then you have to reset. Another month would go by. It's been 3 months, you should get a paycheck. I'm going, wait a minute, what happened to Mr. I got this? Having to go through that, and not just once, but repeatedly over that same year, taught me, I was like, wait a minute, you're not as good as you think you are. You're good enough to have gotten here, but there's something else that you need. And it took me for the life of me to figure out what that was, because I still had my Elliott, I still had other things, I was doing the procedures, but it was just not, the chips were just not falling where I needed them to go. Then your investors start frowning. They're like, well, is he good, or blah, 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 blah. Then you work, and you get lucky. And I went, oh, that was luck. And I saw it. And I went, I need something way better. I need a better mind state. I need a better hit this from a different spot. And that really started how I looked at risk, how I looked at, and not that I had a bad process, but I really realized in that moment I needed to improve to not only go to where I was going, but to stay where I was, which was frightening. It was the first real failure I'd had since probably like college, like real staring you in the face, like you're not good enough. And that was a moment. I still remember that.
That's thanks for sharing.
Yeah, I mean,
Sure.
the older I get, the more honest I get. I'll tell you more about my losses all day, because they, more so than the wins, they shape. Even now, if I take a loss, like now, a loss now doesn't damage because I don't leave myself very open, but I've had some losses at the worst timing ever. Like being up, like again, we get paid at the end of the month, being up on the 29th of the month and getting greedy and scratching those out until you, instead of like, oh, I was going to get paid 20 bands, I'm now getting nothing. And it's little things like that. It's like, why did you, like, I could have not gone to work that day. I could have just played video games or something. And so it's just like, you really start to examine your own decision-making, because it really, no matter you're an engineer or, you're a poet or whatever, when you come to the market, it's all about decision-making, because even good decisions can turn out to be bad. But as you accumulate them over time, you have a much better path of you making good decisions than bad ones, or just getting lucky. The worst thing you can do is get lucky at the wrong time, because it'll fool you if you got the wrong mindset.
Makes sense. Wow. Thanks. Sure.
Oh, no problem, man.
Somebody in the chat asked if you ever ventured into real estate.
Oh yeah, yeah. I'm looking at real estate now in U.S. territories, a little bit outside the United States. That's all I'll say. But yeah, we we had a real estate company. Like I still own some real estate, some just individual houses and things of that nature. But we owned a couple of friends of mine. Again, all of them are investors of some sort. We got together and we pulled together about $750,000 and went to Atlanta and started investing in like the trap. And it was so hilarious because we had everything. We had people who had made millions in real estate, millions in other markets. They had expertise, but we had a bunch of chiefs and no Indians. And it's funny looking back because it was no real trading plan. Like we were just going out and we would buy what felt right and things of that nature. And we ended up doing everything wrong, but we had such sublime timing and didn't know it because we didn't have the data. We weren't taking the time to say, hey, what we're doing. And for perspective, we started buying in 2014 in Atlanta. We were buying houses, 20, 30,000. We flip them for 80 and be like, hey, we making money. Well, those same houses now have added, where they were at 20, they're now added to 0. They're like 200. I remember one of the houses we sold for 80. Somebody else went and bought it. They sold it for 140, and that person ended up selling it for like 220 in like a year and a half between each other. And we went, what? So it was, and I had one buddy, we were talking about that. He's really big in real estate all over. He was like, yeah, man, he said our 750K would have been about 8 million right now at our lowest estimate. And I was like, what's cash on cash return? He was like, probably north of 30, 40%. I was like, let's stop talking. Let's look to the future. So yeah, I've been in real estate. It's not I'm learning more to be in the market, but it's a different type of cerebral thing. I really enjoy the markets. I do real estate to kind of challenge myself because I'm a fish out of water, and I'll be the first to say it. So I like it, but again, the tools that I use and the data that I look at, it's hard to find that data. So you have to look at different things in real estate. But I like it again as a great diversifier, especially against inflation.
What else we got in the chat? We got 40 folks still rocking.
I see it.
Bounce. Appreciate you, DC, of course. It's that Club MSC on a what is this, a Tuesday?
I gotta check y'all out on Friday then. If this is what we're doing on a random Wednesday, I was like, yeah, Friday, we gotta rock this out on Friday. So
this is it, bro. Like, this is really, instead of you answering questions, it'll usually be me.
Love it.
Open it up, bro. And whoever has questions, whoever wants to hop on the mic, and maybe somebody, because that's how DC, we were able to connect. The guy you were just speaking with.
Yeah.
I opened it up and he started saying something about the yield curves and the
that's
bonds, and I'm like, hold on, man, hold on. You over here, you want to take the Zoom? I'll make you host. Like, it's like, yeah, sure, I got some things I can share. I'm like, bet. And next thing you know, he turned that one into like a 2-hour like seminar.
Wow.
On the macroeconomics and all that. I'm like, yo, yep, come on, run it back. So,
I like that. I'm game.
Yeah, it's great, bro. So we'll see what's up Friday, and if anybody else has any questions, we can definitely take them in. But if not, we'll take it, bro. Yeah, no doubt, DC. Yep. I will say, Mike, you might want to make sure you get some rest. Whether you take a nap on Friday or if you want to get to bed early Thursday, because we have been known to have people go to sleep on the Zoom and then wake up and we still on the Zoom.
That'll be me. Go to sleep on the Zoom and then wake up, y'all still going.
Yeah, they'll. I ate dinner, went to bed, woke up. I ate breakfast on the Zoom.
Literally, you're talking like 8 hours, 10-hour Zooms.
Yeah, we have had 10 hours.
Crazy. Yo, I see Kate out there.
Is that Kate that had their hand raised?
Yep.
Anybody can unmute. It's completely open. Kim said that was her last week. Sean said, yeah, 8 hours. Yeah, our longest Zoom was 10.5 hours.
That's insane. Almost a half day.
Yeah. But I mean, as long as people want to learn, bro, and
Yeah.
Man. See, we got anybody else? Any other hands? Any other questions? Anything? If y'all want to learn from Mike deeper, DM me. I put a link in the chat. I'm gonna put a link with the recording too, but DM me as well. I got with Mike, got with Kim, got the plug.
I appreciate it.
Yeah, I'm about to enroll in these. I saw you had a package on your site for like entrepreneur traders.
Right.
Wow.
Yes. It's different because again, I learned from that same experience. It's like it's different when you're at the gun, trying to build your business, and trading is. Both of them are entrepreneurs. You really got two masters, so it's a different way of doing it.
So man, that's the spot I'm in, bro. All the time. I'm
Yep.
trying to trade, and I got the Discord, and then man, it'll be like one person in the Discord that say, this sucks. And I'm like, you know what? Fine. I'm shutting the Discord down. I'm just gonna trade. But then I'm like, nah. These my people, bro. These my people. But it definitely does. I'll say just from a mental standpoint, it can take a toll, really.
Oh, absolutely.
Trying to manage it. And I guess because my business is tied to trading.
Yes.
Then it's like a double. Like,
it is.
But man, I'm definitely about to go ahead and hook that up. And see, because like you said, I like how you mentioned, using it in addition to, that's what Kim was saying too, is like, you don't stop what you're doing, but using this in conjunction with what you're already doing can make it that much better.
Yep. I swear by it. So,
hey man, you managing multi-millions. I'm managing not multi-millions. So
right. Hey, you can look. It comes, like I said, we were in the low sevens for a long time. Then all of a sudden it was pop.
I'm gonna take what you said, man.
Yep. It's gonna come when you least expect it. Because again, I was expecting to close down the business, honestly, in coronavirus, because I was stuck at home with the kids. So I was like, I came this long to get stopped here. It wasn't a stop, it was a stop light.
Dude, I had one of those experiences myself. I had two of those experiences where my Instagram actually got taken down. So I'm not gonna get all deep into the storyline, but somebody paid somebody to get my page taken down.
Yep.
And I was like, dude, forget it.
That's how you're winning, though, man.
Yeah, and then people were like, no, like you were helping people, you were making impact. I'm like, yeah, but I gotta go redo all this stuff. But that was just one thing. I'm like, it was definitely worth it to not stop. And not stop you, especially when you're on a mission. You're gonna get tested. Your mission is gonna get tested. That's how you know it's real.
It is.
You push through it, and it's continuing to grow exponentially after that. Mm-hmm. That's how you know it's real.
Hey, facts. Yep. So, that's why I'm here now, because I mean we've had 3 points where I literally could have woke up and it was like it's all over. So back to the 9 to 5, but. No.
Hey, and that's the thing. That's the other thing that keeps me. I'm like, man.
Yep.
Nah.
Look, 9 to 5s are useful. Don't let me even say, get caught saying I disparage the 9 to 5. Now, 9 to 5 is how I got to this point. But man, I promise you, I'd hurt something before I went back.
My gosh, bro. I've thought about it. I've had offers, and the first thing in my mind is, I could put all that in my trading account.
Exactly.
Like, that's what I was doing before, but then I'm like, yeah, but I like waking up when I want.
Yes. It's the time. Is that what's the cost of time? Time is the most expensive commodity you have. You don't know how much you have of it.
And I'd rather spend it all on Zoom.
Yep, right.
10 hours right here, and the group know they can't get me off of Zoom, man. They'll be like, Jordan, you sleep talking, go to bed. I'm like, nah, ask more questions. I know it's stuff y'all need to know. Ask more questions.
That's dope.
Bro, it looks like that's it, man. We don't have more questions here, so I'll end this recording as well.